talk further about economic indicators and where markets might be going. Colin, I know one thing you watch closely is the Atlanta Fed GDP Now forecast. First of all, explain to us what that is and what we're seeing lately from that indicator.
Absolutely. So the Atlanta Fed, as we know, the Fed has 12 different regional banks, and different banks put out different statistics. For example, the St. Louis Fed puts out a lot of data related to the size of the Fed's balance sheet. The Atlanta Fed puts out a faster forecast of U.S. GDP as the indicators come out at various points in time. They adjust their GDP forecasts to give an idea of what things are looking like. And so for Q1 through November, December, even January, things were running pretty good, nicely positive. And then in about the last 4 to 6 weeks, it's gone completely off a cliff from, say a nice positive quarter to definitely looking like a negative first quarter for U.S. GDP. And that seems to have found its way into the markets, where people are starting to recognize, well, if the U.S. economy is slowing dramatically and quite abruptly, then what does that mean for corporate earnings, and what does that mean for valuations?
What are we've talked a bit about tariffs, and that gets most of the attention when people talk about the market, the economic uncertainty, and therefore the market uncertainty that we're seeing. What about the effects of U.S. spending cuts, which seem to be working their way through Congress, but there appear to be large cuts coming on the fiscal side?
Oh yeah, and certainly, I mean, the government is a significant portion of the economy. So whether it's government cutting back or corporations cutting back, if you see reduced spending in the economy, then growth is likely to slow and could even turn negative in the short term. And even President Trump has started to talk a little bit about that. There could be some bumps along the way from getting to where we are to where they want things to be.
In terms of just circling back to the stock markets, most of the attention on the big market declines we've seen recently is focused on the NASDAQ composite. That's where the growth has been for a couple of years. The NASDAQ has outperformed the S&P 500 by a wide margin in 2023 and 2024, 20% plus gains in each of those years. So perhaps intuitively, it falls the most when markets begin to sell off steeply, when market panic, if you want to call it that, takes hold. But we've also seen, Colin, a big decline recently in the Russell 2000. What's your take on that? I mean, a big part of the market narrative recently has been that the markets were becoming more comfortable with small and more attracted to smaller cap stocks.
Absolutely, but the smaller cap stocks also generally are seen as being higher risk relative to more mature large cap companies. They tend to be more either smaller companies that are more vulnerable to economic swings, or high growth companies that either could be richly valued, or that investors are pricing in high growth that may not materialize if the economy slows. And that's what we've seen. And you mentioned it with the NASDAQ as well. It's the first things people have started to sell are the high growth, high momentum names. We've also seen a pullback in a lot of the large cap names. And what that suggests to me is that often when you get into these first phases of a sell-off, people have been overextended and get hit with margin calls. And when people get hit with margin calls, it sounds counterintuitive, but they sell two things. They usually sell their winners, and they usually sell the most liquid stocks they can find. Wherever they can raise money the fastest is where they look. So another thing with small caps is they tend to be a little bit less liquid as well, so they can get hit harder when selling pressure does emerge.
That's Colin Cieszynski. We'll be back again with Colin to continue